All right, class, welcome. Today, we are going to tackle one of the most important financial documents you'll ever work with, not just in this class, but in your entire career. I'm talking about the income statement. For any of you who want to be managers, entrepreneurs, or investors, let me be clear. Understanding this statement isn't just some accounting chore. It is the absolute key to understanding how a business is actually performing.
So let's start with something you can all picture. Think about that local coffee shop near your apartment. It's always packed, right? There's a line out the door in the morning, the baristas look like they're in a frenzy. Your first thought, your gut reaction, is probably, wow, this place must be rolling in money. But here's a fundamental lesson for business. Being busy doesn't always mean you're being profitable. So how do we get past that gut feeling? How do we know for sure if all that activity is translating into actual financial success?
Well, the tool we use to get to the bottom of that question, that's the income statement. I want you to stop thinking about it as just a spreadsheet full of numbers. Think of it as a story. It's the narrative of a company's financial journey over a set amount of time. It tells you exactly how the money came in, exactly where it all went, and, most importantly, what, if anything, was left over at the end of the day. It's the performance story, plain and simple.
Okay, so here's our game plan for today. We're going to start by really digging into what the income statement is. Then we'll break it down piece by piece. We'll look at the money coming in, which is revenue, and the money going out, the expenses. We'll walk through how to calculate the profit, and then we'll see how this whole story connects with other key financial statements. And finally, the most important part, we'll see how to use this thing to make a real-world strategic decision.
All right, first things first, let's build a solid foundation. Before we can start analyzing anything, we have to be perfectly clear on the fundamentals. So, what is an income statement, really? What's its job in the grand scheme of business and finance?
So here's the formal definition. It's a report showing performance over a specific period of time. Now that phrase right there, period of time, is critical. I want you to underline it in your notes. Why? Because this is what makes it different from a balance sheet. A balance sheet is a snapshot, a photo taken at one single moment. The income statement, on the other hand, is a video. It shows you the action, all the sales, all the costs that happened over an entire month or a quarter or a year. And by the end of that video, you see the result. Did the company make a profit or did it suffer a loss? That's why you'll often hear it called a P&L statement. It stands for profit and loss.
Every story has a beginning, right? In the story of the income statement, the beginning is always what we call the top line. You're going to hear this term a lot in your careers. And the top line is always one thing, revenue. So what is revenue? Simply put, it's all the money that comes in the door from doing what the business is supposed to do. For our coffee shop, it's every single dollar they get from selling coffee, croissants, and those branded mugs by the counter. This is the gross amount before we take out a single penny for costs. Revenue is the engine of the whole operation. It's the lifeblood. Without it, nothing else matters. The story starts and ends right here if you don't have it.
So let's put a number on this to make it real. Let's say our busy coffee shop over the last quarter, that's 3 months, brought in a total of $100,000 in sales. That's our top line. It's a great number, it looks impressive, but it's only chapter 1 of our story. Okay, 100 grand sounds fantastic, but we all know it's not that simple, right? As they say, you have to spend money to make money. And that brings us to the next absolutely crucial part of the story, the expenses. All the costs the business had to pay to generate that revenue. Now this right here is one of the most important distinctions I need you to grasp as future managers. We have to split our costs into 2 big buckets. First, we have the cost of goods sold, or COGS. These are the costs that are directly tied to making the thing you sell. For every latte, you have the cost of the beans, the milk, the cup. If you sell more lattes, these costs go up. Sell fewer, they go down. The second bucket is operating expenses, or OPEX. These are the costs of just keeping the doors open. The rent, the salaries for your baristas, your marketing budget. You have to pay the rent whether you sell 1 latte or 1,000. Understanding this difference is absolutely vital for making smart decisions.
So let's plug in the numbers for our shop. Let's say their direct costs, the COGS for all the beans and milk and cups, came to $30,000. And then their operating costs, rent, salaries, utilities, added up to another $50,000. So you add those together and you've got $80,000 going out the door for the quarter.
Okay, now we have the 2 main characters in our story, the $100,000 in revenue coming in and the $80,000 in expenses going out. Now we get to do the core calculation to find that legendary bottom line, the ultimate measure of whether the business actually made money.
Now there's a specific and very logical order to this calculation. We start at the top with our $100,000 in revenue. First, and this is a key step, we subtract only the direct costs.
the COGS, which was $30,000. That gives us a really important number called gross profit, $70,000. Now pause here. This number tells you how profitable your actual product is before you even think about overhead like rent. From that $70,000 gross profit, we then subtract our operating expenses of $50,000. And what's left, the final number at the very bottom of the statement, that's our net income, $20,000.
And there it is. We finally have the answer. After we account for every single dollar spent, both on the coffee itself and on running the shop, we find that our busy coffee shop was in fact profitable. It generated a $20,000 profit for the quarter. So now we know it's not just busy, it's actually making money.
Okay, this next part is where a lot of students get tangled up, so let's really focus in here. We calculated this $20,000 profit. Great, but where does it go? It doesn't just evaporate, it has to go somewhere. Understanding its destination is the secret to seeing how all these different financial statements are part of one big interconnected system.
And this brings us right back to our analogy. Remember, the income statement was the video of the whole quarter's performance. The balance sheet, on the other hand, is the snapshot. It's a picture of what the company owns, what it owes, and what it's worth at one specific moment in time, the very last second of that quarter. Here is the connection. That $20,000 in net income literally flows from the bottom line of the income statement over to the balance sheet and gets added into a line item called retained earnings. Retained earnings is part of the owner's equity. So, the profit earned during the period directly increases the overall value or equity of the company. The end of the video updates the next snapshot. That's the link.
So, we understand the mechanics. But who cares, right? Why does this actually matter? This is where we make the leap from being a historian who just reports what happened to being a strategist who uses this information to make smart decisions about the future.
So our coffee shop owner is feeling good. They see that $20,000 profit and they think, we're a success. It's time to grow. Let's open a second location. And that's a common impulse. But a savvy manager, which is what all of you are training to be, knows that making a huge expensive decision like that based on just a good feeling is a recipe for disaster. You need to analyze the data. We can use the exact same income statement structure to build a projection, what we call a pro forma statement. It's a what-if scenario. So let's project that the new location might bring in a little less revenue at first, say $80,000. Maybe COGS are a bit lower, $25,000. But here's the kicker. The rent in this new neighborhood is way higher, pushing our operating expenses up to $60,000. When we run those numbers, what do we see? We see a projected net loss of $5,000. This little exercise perfectly highlights the classic mistakes that so many people make. It is so easy to get dazzled by that big, shiny revenue number, $80,000. But that's a trap. The mistake is ignoring how a single changing variable, in this case, much higher rent, can completely flip the script and turn a profitable idea into a money pit. You can't just assume the future will look exactly like the past. And that is the power of using financial statements for decision-making. The projection gives the owner the data they need to make the right call. Instead of rushing into an expansion that would likely fail, the smart strategic decision is to wait. Focus on making the first store even more profitable, build up a stronger cash cushion, and then reconsider expanding from a position of strength. So if you take one thing away from our discussion today, let it be this. The income statement is so much more than an accounting document. It is a strategic narrative. Learning to read it isn't about bookkeeping, it's about learning to understand the story of a business. It shows you the past, it diagnoses the present, and it gives you a map to navigate the future. And as future leaders, there is no more valuable map you can learn to read.